Finance now is P&G Chairman, President, and CEO Jon Moeller. Jon, always great to get some time with you here. Just looking at the earnings, let's start on the earnings front. I think a lot of folks might be a little surprised coming in a little light versus estimates on profits. Was there something that surprised the team in the macroeconomic environment as it played out?
First of all, really strong results. 7% top line growth, 7% bottom line growth, 12% growth on a constant currency basis, and 99% free cash flow productivity. We missed outside estimates by 1 penny, and that was driven primarily by the impact of the shutdowns in China related to COVID and due to what's happened in Eastern Europe with Russia and the Ukraine.
The core organic sales, to your point, very strong. What drove that?
Superior offerings in categories, daily use categories where performance drives brand choice. And you see it across the board, which speaks to the strength of the strategy. 9 out of 10 categories grew sales. We built 50 points of aggregate market share in the quarter, all doing very well.
The last time we talked a couple of months ago for earnings, you mentioned that you were looking at some more price increases. The inflation environment out there is brutal. There's no other way to put it. How do you think consumers have responded?
Well, you see it in the numbers. We've tried very hard to combine innovation with pricing so that we improve performance in categories where performance drives brand choice and hold or build the total value proposition that we're offering to consumers. And so far, that's held up very well.
Do you see a shift to private label goods?
On the margin, we see private label shares up about 20 basis points, while at the same time, we're building share at higher rates than that.
How do you respond? With that share shift underway, how do you respond? Do you have to develop new type of more value-focused products?
We're in very good shape in that regard. We've really spent a fair amount of energy on increasing the depth of our portfolio. So, for example, you can buy Tide Power Pods at 50 cents per wash load. You can buy regular Tide Pods at 30 cents per wash load. You can buy Tide Simply Pods at 20 cents per wash load. So offering consumers who do choose to trade down the ability to stay within our brand families. Pampers is another example. Pampers Pure is about 40 cents a diaper, all the way down to Love's, which is at about 20 cents a diaper. So we're very well positioned to be able to offer value to consumers in the way that they define it as a reflection of their personal circumstance.
You've seen a good number of economic cycles in your time at P&G. How would you compare to what we're seeing now in the economy compared to slowdowns in years past?
So it's interesting. We still have very strong consumer demand. We have a very tight labor market. We have strong consumer balance sheets. Those characteristics are a little different than prior trade downs or prior economic difficulties. On the other hand, inflation is very high. We had across ingredients, materials, freight costs, and then foreign exchange, we had about $3.2 billion after tax of headwinds that we had to overcome in the year that we just completed. And we'll face a similar challenge as we head into next year. So that's the difficult part. But again, we're well positioned with a strong portfolio. We've developed a very strong productivity muscle, generating over $1 billion in savings per year. And we've really invested in the superiority of our offerings, product, package, communications, go-to-market, value. Those are the things we can control, and we're all over it.
When you slice and dice the numbers, do you get a sense that the U.S. consumer is hunkering down for a recession?
We don't get that sense.
Interesting. So over the next 12 months, within your outlook, you did mention a good bit of inflation and, of course, currency headwinds. Any signs of a peak yet in inflation?
We're seeing some rollover in some of our input costs, but others continue to increase. So the picture isn't entirely clear. We do our planning based on spot rate, and that's what we're managing against. So we're not assuming that things have peaked or that they'll necessarily increase. We're planning based on spot, which is the cumulative intelligence of the market today, which is certainly greater than mine.
Within the outlook, are you still planning for the U.S. economy to grow?
Modestly, yes.
Interesting. Okay. And the buybacks, how much do you think you'll do within that fiscal year?
We're projecting $6 to $8 billion of buybacks in the year that we're headed into, in the fiscal year that we're headed into. And that will be on top of $8 billion in dividends. So at a midpoint within that range, we'll be returning $15 billion of cash to share owners.
And any change on how you think about hiring in the organization? There's been a lot of executives reining in how much they're hiring, but not at the pace they were. How are you doing at P&G?
Because demand is so high for our products, and we're not fully meeting that demand, we continue to hire.
All right, we'll leave it there. P&G Chairman, President, and CEO Jon Moeller, always good to get some time with you. We'll talk to you soon.
Thank you.